How Buffett chooses stocks for growth and stability. Warren Buffett is often described as a value investor, but in reality, his strategy goes far beyond simply buying cheap stocks. Buffett focuses on finding businesses that can grow steadily over time while remaining stable during market downturns. For him, growth and stability are not opposites, they are partners. In this first part, we will explore the foundation of how Buffett selects stocks that can both grow and endure. Buffett begins with a simple but powerful rule: invest only in businesses you can understand. He calls this his circle of competence. If a company's business model is too complex, depends on unpredictable technology, or changes rapidly, Buffett usually avoids it. He prefers companies with clear products or services, predictable demand, and a long operating history. This clarity allows him to better judge whether the business can continue growing without taking unnecessary risks. The next thing Buffett looks for is a durable competitive advantage, often referred to as an economic moat. This moat protects a company from competitors and helps ensure long-term stability. Examples include strong brand loyalty, cost advantages, network effects, or regulatory barriers. Companies like Coca-Cola, Apple, and American Express fit this model because customers repeatedly choose them, even when alternatives exist. A strong moat allows a business to raise prices, maintain margins, and grow earnings over decades. Buffett also places great importance on consistent earnings growth. He is not interested in companies that show explosive growth one year and heavy losses the next. Instead, he studies long-term financial records, often looking back 10 to 20 years. Stable and gradually increasing earnings signal that the company's business model works in both good and bad economic conditions. For Buffett, consistency is a sign of reliability, and reliability is the foundation of stability. Another key factor is high-quality management. Buffett looks for leaders who are honest, capable, and shareholder-friendly. He carefully reads annual reports and letters from management to understand how they think. Managers who allocate capital wisely, avoid unnecessary debt, and focus on long-term value creation earn Buffett's trust. He believes that even a great business can fail under poor management, while a well-managed company can thrive for generations. Finally, Buffett evaluates a company's financial strength. He prefers businesses with strong cash flows, low debt, and the ability to generate returns without constantly needing external financing. Companies that can fund their own growth are more resilient during market crashes and economic slowdowns. This financial stability gives Buffett confidence that the business can survive tough times and continue growing when conditions improve. In short, Buffett's approach to choosing stocks for growth and stability starts with understanding the business, identifying a strong competitive advantage, demanding consistent earnings, trusting quality management, and ensuring financial strength. These principles form the foundation of his investment philosophy and set the stage for how he decides when and at what price to invest. Valuation, patience, and long-term conviction. After identifying a high-quality business with strong growth potential and long-term stability, Warren Buffett moves to the next crucial step: valuation. Even the best company can become a poor investment if bought at the wrong price. Buffett often says, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This idea explains how he balances growth with safety. Buffett does not chase hype or short-term market excitement. Instead, he waits patiently for opportunities when the market undervalues a strong business. He studies intrinsic value, the true worth of a company based on its future cash flows. If the stock price is significantly below this intrinsic value, Buffett sees it as a margin of safety. This margin protects him from mistakes in judgment and unexpected economic shocks. One of Buffett's favorite tools in valuation is discounted cash flow thinking, even if he does not always use complex formulas. He asks a simple question: how much cash will this business generate over its lifetime, and what is that worth today? Companies that can reliably produce increasing cash flows over many years are ideal candidates. Growth matters, but only if it is sustainable and backed by real profits. Patience is another cornerstone of Buffett's strategy. He is willing to wait years, even decades, for the right opportunity. While many investors feel pressure to constantly buy and sell, Buffett is comfortable doing nothing when prices are too high. He believes inactivity can be a powerful advantage. This patience allows him to avoid overpaying and to act decisively when rare opportunities appear. Buffett also thinks in decades, not quarters. When he buys a stock, he imagines owning the entire business forever. This mindset shifts his focus away from short-term price movements and toward long-term business performance. Temporary drops in stock price do not worry him if the company's fundamentals remain strong. In fact, he often welcomes market declines as chances to buy more shares of great companies at better prices. Another important aspect of growth and stability is reinvestment. Buffett favors companies that can reinvest their earnings at high rates of return. When a business can use its profits to expand, innovate, or strengthen its competitive position without taking on excessive debt, long-term growth becomes almost automatic. This compounding effect is one of the main reasons Buffett has achieved extraordinary results over time. Buffett also avoids excessive diversification. While he believes in risk management, he prefers to concentrate his investments in his best ideas. By deeply understanding a few outstanding businesses, he reduces risk rather than increasing it. To Buffett, risk comes from not knowing what you own, not from owning fewer stocks. Management quality, financial strength, and competitive advantage. In the third stage of Warren Buffett's stock selection process, the focus shifts from numbers on a page to the people running the business, the company's financial health, and the strength of its long-term competitive position. Buffett often says that when a business is easy to understand, well-managed, and financially strong, time becomes its greatest ally. Buffett places enormous importance on management quality. He looks for leaders who are honest, capable, and shareholder-oriented. Integrity comes first. No matter how profitable a company appears, Buffett avoids it if management cannot be trusted. He believes that poor character will eventually destroy even the strongest business. Great managers, on the other hand, treat shareholders as partners, communicate clearly, and allocate capital wisely. A key trait Buffett admires is rational capital allocation. Management must know when to reinvest profits into the business, when to acquire other companies, and when to return money to shareholders through dividends or share buybacks. Buffett respects executives who avoid empire building and instead focus on decisions that increase long-term per share value. In his view, disciplined capital allocation is often what separates average companies from exceptional ones. Buffett also prefers managers who allow the business to run efficiently without constant micromanagement. He famously favors companies that could be run by someone, not too smart, because eventually, they will be. This means the business model itself should be strong enough to survive leadership changes. When a company depends too heavily on a single visionary leader, it may lack durability. Beyond management, Buffett closely examines financial strength. He looks for companies with strong balance sheets, consistent earnings, and healthy cash flows. Low debt is especially important. While some companies rely on heavy borrowing to fuel growth, Buffett prefers businesses that can grow using their own cash. Debt increases risk, especially during economic downturns, and can quickly turn a good business into a fragile one. Buffett is particularly attracted to companies that generate large amounts of free cash flow. This cash gives businesses flexibility. They can reinvest, reduce debt, reward shareholders, or withstand tough economic periods. Consistent free cash flow is a sign that a company's profits are real, not just accounting illusions. One of the most powerful concepts in Buffett's philosophy is the economic moat, a durable competitive advantage that protects a company from competitors. Buffett looks for businesses with moats so strong that rivals struggle to erode their market position. These moats can take many forms: strong brand recognition, customer loyalty, cost advantages, network effects, regulatory barriers, or proprietary technology. Brand power is a classic example. Companies like Coca-Cola, Apple, and American Express have brands that influence consumer behavior across generations. Customers willingly return, even when alternatives exist. This brand loyalty allows such companies to raise prices without losing customers, protecting profits over time. Cost advantage is another powerful moat. Companies that can produce goods or services at lower costs than competitors can undercut rivals or maintain higher margins. Over time, this advantage becomes extremely difficult for others to challenge. Buffett values businesses that have achieved such efficiency through scale, experience, or unique processes. Network effects also play a major role. When a company's product becomes more valuable as more people use it, competitors face a steep uphill battle. Payment networks, marketplaces, and platforms often benefit from this dynamic. Once established, network effects can lock in users for decades. Buffett also considers consistency a form of strength. He prefers companies with stable demand, predictable revenue, and products that people will continue using regardless of economic conditions. Businesses that sell everyday necessities, food, beverages, insurance, utilities, often perform well even during recessions. This stability balances growth and reduces downside risk. Importantly, Buffett avoids industries undergoing rapid, unpredictable change. He does not invest where future competition is unclear or where technology could quickly make a business obsolete. This is why he stayed away from many tech companies for years, only investing when their business models became clear and durable. Patience, market discipline, and the power of compounding. The fourth and final part of Warren Buffett's approach to selecting stocks focuses on time, patience, and disciplined investing. While previous parts covered understanding businesses, evaluating value, and analyzing management and competitive advantages, this part is about how to act, or not act, once you've chosen the right company. Buffett often emphasizes that the stock market is a device for transferring money from the impatient to the patient. This statement reflects his deep belief that success in investing comes less from timing the market and more from holding great businesses over the long term. Buffett's first rule of investing is famously simple: never lose money. But his deeper philosophy revolves around risk management through patience and knowledge. He doesn't chase short-term trends or speculate on price movements. Instead, he invests in businesses he understands thoroughly, buys them at a fair price, and allows time to amplify their value. This approach may seem boring in an age of rapid trading, but it is extraordinarily effective. One of the central principles in this final part is the power of compounding. Buffett calls it the eighth wonder of the world. By reinvesting profits, dividends, and returns year after year, an initial investment can grow exponentially. But compounding only works if the underlying business continues to perform well, and the investor avoids emotional decisions that could disrupt growth. Buffett often illustrates this with examples like Coca-Cola and See's Candies, companies that he bought decades ago and still hold today, allowing decades of compounding to maximize returns. Patience in the face of market volatility is another critical lesson. Markets fluctuate daily, and stock prices rarely move in straight lines. During economic downturns, panic selling can wipe out years of potential gains. Buffett advises investors to view market declines as opportunities, not threats, provided the company's fundamentals remain strong. A temporary price drop is irrelevant if the business is sound. In fact, such moments often provide chances to purchase quality stocks at discounted prices, a concept Buffett refers to as being greedy when others are fearful. Discipline is intertwined with patience. Buffett insists that investors must have clear criteria for buying and selling and adhere to them without succumbing to hype or fear. Emotional decision-making is one of the largest threats to long-term wealth. Investors who panic during downturns or chase fads often realize losses, while those who stick to principles benefit from the market's natural growth over decades. Another major aspect of this part is long-term focus. Buffett views ownership in terms of decades, not months. He famously says, "Our favorite holding period is forever." By maintaining a long horizon, investors can ride out economic cycles, benefit from compounding, and avoid costly mistakes driven by short-term market noise. The patient approach allows them to capture the full value of exceptional businesses. Buffett also highlights the importance of margin of safety. Even when a company appears excellent, paying a reasonable price matters. Overpaying for a great business can reduce future returns and increase risk. Combining patience with smart valuation ensures that investments have room for error, further reducing potential losses. Lastly, Buffett's approach emphasizes learning and continuous improvement. He encourages investors to read, analyze, and stay informed. Understanding businesses deeply, monitoring performance, and avoiding speculation allows investors to make confident, rational decisions. Knowledge, combined with patience and discipline, becomes a formidable tool for long-term wealth creation.